The stock market is seeing a rally to the upside since the beginning of 2023. After 6 straight rate hikes of 50 and 75 basis points, the Fed has finally dropped the rate hike to 25 basis points in their latest FOMC meeting. The market saw it as an indication of the dropping inflation and a dovish outlook from the Federal Reserve. And many are predicting that the market has bottomed and are expecting market rallies in the upcoming months. Paul Zemsky from Voya Investment thinks so as well. According to Paul, the market has seen the bottom and is primed for the next rally. Watch until the end for his interview, talking about the opportunities investors should know for the next bull market. Last year, with soaring inflation, the Federal Reserve initiated the quantitative tightening and hiking interest rates. Starting March last year, the Federal Reserve has increased the federal funds rate to above 4.5% so far. The rate hike brought uncertainty in the market, which started the long bear market until the end of 2022. But as the inflation rate is steadily dropping, and the job reports showing strong numbers, investors are becoming more confident about the state of the market and its upside. The bulls of the market believe that the rate hike is almost at its end, and the Fed will soon stop hiking the rate. Recent earning reports are showing better than expected results, which is fueling the market's upward trend. According to Zemsky, this could be a great opportunity to invest in growth companies like big techs, but investors should be cautious, since this time, the market may not have free money like during the pandemic. Fed is now operating on some of the lagging indicators like job report and inflation data. If some of the indicators changes, the Fed's decision may reverse, and the market may head in the opposite direction. Only time will tell if the market will be dominated by the bulls or the bears in the coming months.
Is Paul Zemsky. He's Voya CIO of Multi-Asset Strategies and Solutions. And Paul, the market was of two minds listening to this yesterday. On the one side, yes, rates could go higher than the market's anticipating. On the other side, he still continued with that disinflationary kind of thought process, that more dovish tone than we've heard recently. I think you're of the opinion that you're going to be looking at the dovish tone of things, right?
Absolutely. Last year was just a year of so much uncertainty, and this year we're starting to figure things out. And, from the market's perspective, I really think whether the Fed needs to tighten another 25, 50, or 75, it's really not going to matter all that much. We're not talking about the Fed going to 6 or 6.5, where, a year ago when Fed funds were 0, nobody knew how high they were going to go. A lot of uncertainty. This year we're almost done, and whether it's another 25, 50, or 75, it's still pretty close to finished.
Yeah, I think that's a really interesting perspective. I think it explains a lot about why the market's maybe been so bullish the first month and into the second month of the year. You do see red arrows in the morning a lot. Joe was just talking about this. We saw this Monday. We saw this yesterday, where it looked like we were going to open up pretty low. But the market manages to claw its way back. And maybe that's just what this is about. We've seen the worst of the rate hikes.
I think that's right. And, there are rate cuts priced in at the end of the year. While that seems far-fetched, if the Fed achieves its goal on inflation, meaning if, core PCE inflation right now is, let's say, 4.5, they get it down to 3.5 by the end of the year, that's a de facto tightening. Because you look at real rates, which are nominal rates minus the core PCE inflator, if that drops by 100 basis points, in fact, the Fed's going to be 100 basis points tighter at the end of the year. So they will have to really consider easing. And the market's thinking about that too. So a lot of factors go on overnight, but in the U.S., when the market opens, I think people focus on the fundamentals here.
If that's your thesis, do you buy into growth stocks? Because those are the ones that have been hurt so badly by what the Fed's been doing.
Yeah, so select growth stocks, I'd say quality growth. Companies that have no earnings, we're not going to go back to the pre-Fed tightening era of, any stock with that's Web3 or internet-based or anything like that is going to just get incredible multiples. However, quality growth stocks that have been beaten down, absolutely makes sense.
Do you think the markets have bottomed at this point?
Yes. So I don't see us making a new low in the S&P. We shouldn't make a new high in the 10-year. The other thing we didn't talk about is earnings. Everyone keeps expecting earnings to crater, that, this is a quarter where earnings are going to get the comeuppance. And the reality is that profitability is still high, margins are still high. We're not going to have a deep recession. Even if we have a recession, it's going to be a mild one. So, overall, as an investor, I have to think, if I sell stocks here, can I buy them back 10 or 15% cheaper to make the trade worthwhile? I don't really think so.
Right, Paul, I get the long-term bet you're making, but what I don't understand is why you're so convinced. I listened to Jay Powell yesterday, like everybody else, and I thought this guy is going to keep going and going and going and going.
Well, I guess I would differ in the point of going and going and going. I think, another one or two Fed tightenings makes sense.
I know that's what you think makes sense.
Yeah.
I did not read what he was saying is that one or two makes sense, and that's the end of that.
Well, he's also, he's a Fed chairman. He can't lock himself into a decision at this point because the data on Friday was startling. But there's a good chance that employment is a lagging indicator, that labor is still being hoarded. You look at the other parts of the economy, they're slowing down. The PMIs are giving close to recessionary readings. So I think you'd want to take the mosaic. If we have another couple of employment numbers like that, then absolutely. The Fed's going to have to think about another 100, if not more. But there's a
And that changes your calculus then?
Of course it would have to, right? It would have to, right? But if you look at a mosaic of all the economic indicators, it's reasonable to assume that the Fed's going to maybe go one or two more times and let the tight financial conditions just play out.